Hello, for this session we are going to talk about accounting for accounts receivable. Now, if you remember from our previous topics, we've talked about accounts receivable in sales and in services. So for example, for credit sales, for example, you are selling pencils and your customer tells you that he or she will just pay you next time, but you have already given the pencil, then that would be a credit sale. So we debit accounts receivable and credit sales. Now, for services rendered to clients, let's say you are in the business of laundry and you've already washed the clothes of your client, but your client tells you, I will pay next month, then at that point, that would be an accounts receivable from the client. So we debit accounts receivable and credit service revenue. So receivables could either be stated verbally, that's why it's an accounts receivable, or if it's written in a formal note, that would be a notes receivable. The general term for these receivables would be trade receivables, and these are receivables that occur during the normal operating activities of the business. For the purpose of discussion and because of the lack of time, we will omit notes receivable and we will focus on accounts receivable. Now, there are also non-trade receivables. An example of this would be advances to officers and employees. So in this case, you have already paid your employee in advance for services that your employee will perform, let's say, next year. And what happens is you debit advances to officers and employees, and then you credit cash. Here in this scenario, what you are actually waiting for would be for your employee to render services to you. And that's how it works. Now, let's focus on accounts receivable. So as a refresher, remember that they are recognized when the title of the goods are passed on to the buyer in the case of a merchandising business, or when services are performed if you are in the business of service. For this chapter, we will use the allowance method to recognize and estimate accounts receivable for the period. So to estimate or to recognize that we won't be able to collect the entire amount of our accounts receivable, to recognize that possibility, what we will do is we debit bad debts expense, okay, and this account will be part of the income statement, and then we credit allowance for bad debts, which will be reported in the balance sheet. So allowance for bad debts is actually a contra asset or contra account, and this is subtracted from accounts receivable. So what happens here is every year or every period, bad debts expense would be recognized to capture the possibility of not being able to collect from your accounts receivable. And then the allowance for bad debts would also increase in line with your bad debts expense, except for this one, this account name here, this is a permanent account, so the value would be carried over from one accounting period to the next. In other textbooks, allowance for bad debts would also be called allowance for doubtful accounts. Now, let's say you discover that your client or one of your clients already passed away. Now, when this happens, the possibility of not being able to collect is already real. It's not just a possibility, it is already tangible. And to acknowledge that, what we will do is we will write off the uncollectible account, meaning we will recognize that the possibility of not being able to collect is now a reality. So to do that, we debit allowance for bad debts to decrease the value of this account, and then we credit accounts receivable so that accounts receivable will also be decreased. Now, let's say if suddenly we discover that apparently our client did not pass away, apparently he's alive and he's safe, then we have to recognize that, oh, okay, it's still possible to collect from this client. So to revive that receivable, what we will do is we will debit accounts receivable, okay, and then we reestablish the allowance for bad debts. So in this scenario, what happens is we recognize that we can indeed collect, and also in line with that, there is still a possibility that we won't be able to collect, which is reflected in your allowance for bad debts. Now, let's say your customer decided to pay, then to record the collection of cash, we will simply, okay, it's not written here, but I'll say it. We will debit cash to record the increase of cash, and then we will credit accounts receivable to decrease accounts receivable and to recognize that we have already collected from that customer. Now you might be wondering, how do we estimate allowance for bad debts? Now there are actually three ways. First, it could be based on the percentage of credit sales for the period. The second would be, it could be based on the percentage of the total accounts receivable. And the last but not the least way of estimating it would be the aging of accounts receivable. So let's tackle the first item, okay, this one. Let's say the estimation of allowance for bad debts is based on the percentage of credit sales for the period. And the given that we have here would be 2% of credit sales of 100,000. And let's say in your balance sheet, there's already an amount of 600 pesos in your allowance for bad debts, meaning this amount here was obtained from previous periods. So, okay, if this is the scenario, okay, the first step would be to calculate the 2% of the credit sales. So we'll do that. 100,000 times 0.02 or 2%, you'll get 2,000 pesos. Okay. This would represent the bad debts expense for the period. And when you record this, that the journal entry would be bad debts expense 2,000 and then credit allowance for bad debts 2,000. So this is how it will look like. The bad debts expense will be reported in the income statement, and your allowance for bad debts will be reported in the balance sheet. Since this is a permanent account, this value that we have here would be added to the 600 pesos obtained from the previous periods, meaning after you have recognized the bad debts expense for this period, your allowance for bad debts would be equal to 2,600. The other method of estimation that you can use would be to base it on the percentage of total accounts receivable. So let's say you have a given item here, 3% of total accounts receivable of 50,000 pesos. Okay, and then the allowance for bad debts has an existing balance of 600 pesos, which was from the previous period. And so, if we want to go about this, the first step would be to multiply the total accounts receivable of 50,000 by this percentage, 3% or 0.03, we will obtain 1,500. Now, the value that you get here, this 1,500, this indicates the total allowance for bad debts during that period. Okay. Now, from what we see here visually, we already have 600 from the previous period, and at the end of the period, you need to have allowance for bad debts amounting to 1,500. This means that in the middle, here in this portion, we need to add a certain value so that your allowance for bad debts will be 1,500. Given this, 1,500 minus 600 will give me 900. So that would indicate that your allowance for bad debts will increase by 900. In line with this, to increase allowance for bad debts, it means that your bad debts expense will also increase by the same amount. So your journal entry for that period would be debit bad debts expense 900 and credit allowance for bad debts 900. Okay, so you'll see from 600 we increased allowance for bad debts by 900, giving us a total allowance of bad debts amounting to 1,500. In the next video, I'll be discussing aging of accounts receivable.